MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite. She's also president of Venable Park Investment Council Incorporated. Welcome back to the show, Danielle.
Hello, Jim.
Interesting times for people who thought there might be a big break in the equity markets, and sure enough, the slip has happened. Now I guess the question is, for how long and how big?
Yeah, that is the question, because we did see a sell-off in the late part of 15, early 16, into about February the 10th of that year. I remember it well. It's my husband's birthday. And then all of a sudden it stalled, and we had a rally again. So whether or not this is the final tipping point or just another head fake is not clear. However, I would say that the price and leverage that has been baked into these markets for some time, it means that, the downturn is inevitable. The correction phase, the giving back of prior exuberance has already been baked in, and it's just a question of, what is the final tipping point? I think I've long suspected that when you get this much leverage and debt, both on corporate balance sheets, on margin accounts, people borrowing against stocks to pay their life expenses, never mind buy more stocks, people buying Bitcoin on credit cards. I mean, we have been in a manic episode, certainly for the last year, that has sucked in even the retail crowd who was badly hurt in '08 and had sworn themselves off of speculating. They were flooding back into, long always mutual funds, ETFs, all that good stuff in the past while at these record valuations. So all that really set up for a liquidity crunch, which is where no one has cash set aside. Everyone has so much leverage that when prices move a bit, it can have a very devastating impact. They have to start selling things. They have to start, raising cash as prices fall, and that creates this self-fulfilling cascade of more falling prices.
One of the people I've just talked to suggested that, yes, we'll have a drop here, and then it's going to skyrocket again, and all these young traders who, for the last 9 years, have seen nothing but a positive market, are really going to get sucked in, and they're the ones who are going to be destroyed.
Well, I think that it's wonderful that people make those kind of forecasts, but unfortunately it's already had a massive spike since Trump's election, if you recall. What was already egregiously overvalued saw the highest equity inflows in the past couple of months that we've seen, even higher in many ways on measurements than the tech top in 2000. And we know that most of the people participating have not seen the downside of leverage. Many of them are, under 40, as I say, speculating with borrowed funds or taking all sorts of crazy risk, not appreciating that. And I think that, this has gone on already, one of the longest upcycles in the history of markets. The sentiment indicators were the most bullish we've seen since like 1986 or so. So, I think to say that we could have more hyperbole, more upside, more mania, absolutely, but, this forecast that it would, necessarily have to do anything, I think is highly circumspect.
Also, too, we've seen the, I call them cyber currencies, but cryptocurrencies take a massive fall, and that happened a few weeks before the equity markets. Is that a typical pattern where the most speculative thing is the first to fall, and then you see the rest of it kind of follow?
Well, we've really made such a interwoven mess of leverage and risk and counter markets highly correlated with each other. One of the arguments that the cryptocurrency people were making in the past few months, in the last year, say in particular, or even longer, was that, it was similar to the argument that the precious metal bugs made in the, top of the credit cycle in 06, 07, and it was that they thought everything was overvalued and that markets were, highly untrustworthy and lots of high-frequency trading and all that, which all I agree with. But they said that they thought that their particular commodity, or in this case cryptocurrency, was the only thing that was going to stay up when everything else began to crash. And I thought that was highly unlikely, both in 06, 07 and now, because of the connections, the interconnections, the fact that speculative fever is a phenomenon that has swept the world in the cheap money era, low rates and cheap money. And so people were speculating with cryptocurrencies on borrowed money just like they were speculating on everything else. And what happens then is any price move down, even small moves, are magnified. And especially in things where people have borrowed at high interest rates to speculate on something that, in the case of, for example, like a Bitcoin, crashes 70% in a matter of days or weeks. That really wipes out levered people. And we've seen this, whether you're speculating on treasuries, like the long-term capital crowd was in the 1998 debacle that, caused them to go bust and get bailed out, or whether you're talking about, the mining, commodities, super cycle traders that were gunning for the fences, and as I say, in the debt cycle of 06, 07, or whether you're talking about everything in the everything bubble of late, all those same characters, behaviors, and practices are really what bring the ultimate sort of sentiment shift, and then liquidity crunch, which forces selling across the board. And it's highly contagious. This is one of the things that I've pounded the table on for many years. In these kind of markets, with this much international interconnection between the intermediaries, the central banks, the policy, all the things that are concerted around the world around similar themes, you just don't get diversity benefit in being in, the Hong Kong stock market relative to the U.S., relative to Canada, or commodities relative to corporate debt, or everything that can be speculated on and levered on has gone up together and ultimately gets sold in mass together. Sometimes people start with the things that have fallen a lot in the case of margin calls and that sort of thing, and sometimes people start with the things that have not fallen because they have a presumption that you don't want to sell something after it's gone down. But I think that they are totally unprepared for the magnitude of decline, which has been, as I say, baked in for a long time in these markets. And many of the people have just presumed. You hear this all the time. Why haven't the central banks stepped in to stop this? Because mathematically, this is buttons. So far we've seen, people forget that the index went up so much that the dollar value of the Dow Jones, for example, at 26,000 can have a 1,000-point drop and be a very tiny decline relative to the price. Back when the Dow Jones was, 1,200 or 12,000, if you saw a 1,000-point decline. That was entirely different. So far, we've come off something like 7% in Canada, like just over 6% in the U.S. markets. This is nothing compared to, if this is the extent of the decline, this is barely even a correction. What I think we are susceptible to here is a cyclical decline, the third cyclical decline in the secular bear that began from the peak valuations in 2000. That's what we've been waiting for, because that will be the market clearing event that the speculators, the people who even think that they're not speculating and believe they're investing by buying at any price, the people that are in there for dividends and they think, we're buy and hold, we're holding conservative defensive instruments, we're just collecting the yield. No, when it starts plunging, your savings is plunging along for that ride, and most people will find that they're not able to be buy and hold investors in that environment. Emotionally, psychologically, they will ultimately want to protect themselves and pull in. Unfortunately, the time to do that is when valuations are extreme before the selling begins. And early on in the decline, not waiting until you've lost a ton and then you panic.
We'll have more with Danielle Park right after the break.
Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the US. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the US and GET in Canada. Find out more at glancepay.com.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
Welcome back. We're speaking with Danielle Park. In a market condition like this, should you take your cash and wait?
Well, you should. See, this is the very troubling part of this, is that because people go into these markets with this perpetually long presumption. In other words, if you ask the average advisor, financial person out there supposedly giving people advice on investing, if you ask them when they would sell or take you out of a market cycle, the answer is we wouldn't. 99% of them would say, well, we don't. We may rebalance a little bit here and there, but we believe in long-term blah, blah, blah. What they don't factor in is when you have historic valuations, historic leverage in secular bear cycles, that the downstroke can be 40, 50, 60, 70%. And at that point, it may take years to recover. Typically, that's the story. It takes years to recover the prior cycle losses. And with people not having the bulk of their net savings till they're into their 50s and 60s, they have not got the time, nor the intestinal fortitude, frankly, to wait through that type of loss cycle, even if they're supposedly collecting the dividends. So, the right time to do things is proactively. This is what I'm always trying to tell people. If you're just following the herd, you're following the herd up and you're going to follow the herd down, and then you're going to panic and jump out at the bottom. That is a terrible way to approach publicly traded markets. If you're going to do that, you'd be better to just stay out of them altogether, stay with your GICs, cash deposits, whatever, just live on your interest and steer clear. Unfortunately, most people get sucked in late in the cycle after, the bulk of the easy money's already been made, so to speak. You get into the speculative froth, the overvaluation, that's where more people tend to come in, where they want to put more capital to work, and that's when the mistakes are made. So the time to take stock is before the carnage begins, when you're peak cycle, peak valuations, and you've got a discipline around when you take your profits. That is actually, before the selling starts, that's the right thing to do. Unfortunately, most people don't do that, so they get into the down cycle and then they start to panic. But I still say, when you've seen something like a 6%, 7% pullback, it is not too late to reevaluate your risk exposure. And like I said in an article I was writing on the blog this week, the best thing you can do right now is look at your current holdings. Yes, open your statement. Don't stick your head in the sand. Look at your online portfolio and see, have most of the things you're holding gone down in value in the sell-off over the past couple of weeks? If most of the things you have lost, 3, 4, 5, 6% in that range, that tells you that they're heavily correlated, positively correlated, and move down and up together. So what that means is that you don't have a lot of diversity of any meaningful kind or capital protection. You're highly exposed to the cycle here. And so that suggests that you've got too much risk, especially if this is the bulk of your life savings, if, as I say, you're getting older, because the very likely fallout from the final sell-off, when it gets into the full fruition of its promise from these valuations, is that it'll be much deeper than it is already. And as I say, it will take years to recover the losses. That's what a person has to keep in their mind when they're looking at their current holdings and saying to themselves, oh, I probably shouldn't sell, it's down a couple of percent. That's not the question. The question is, how will you feel when the bulk of your net worth is diving and everything's moving down together, and, it may take a long time to recover. How will you react? How will you feel? How will that serve your life goals?
We'll have more with Danielle Park right after this.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com.
Welcome back. We're speaking with Danielle Park. A recent poll found that 32% of Canadians have no retirement savings. What's going on here?
Well, unfortunately, a good deal of that, there's a few factors at play there. One is this, bad spending habits, spending more than you earn, or spending too much of your income. That's a classic behavior, whether you make a lot of money or a little bit of money. That's what most people do, and that's why savings suffer. The second thing that happens there is that we've had this housing bubble in Canada, thank you very much, which has made shelter costs ridiculously expensive. This has pushed people away from any savings for longer-term purpose, devoting all their net cash flow towards things like keeping a roof over their head. Another thing that's been a problem is this obsession with flipping your cars and new leases and taking out loans and, trading in your vehicle and never paying it off, which also takes away your free cash flow and leaves you with very little to save. So those two factors have been major eroding of the ability to save. And the third thing is that the industry gives horrific financial advice that harms people repeatedly, that puts them into these risk-soaked instruments and tells them they're doing great while it's going up. And then when all hell breaks loose and it starts to fall, they do things like blame the machines, blame the algorithms, blame central bankers, blame speculators. But no one's looking at what kind of risk tolerance and risk exposure should this individual have with the savings that they have been able to amass. And so those factors together have been catastrophic for individual household balance sheets over the past couple of decades. Like I said, we've had two major wipeouts that set people back 12 years in capital value, each of the last two declines. And we are set up for a third one to do a similar affront. So you can imagine if people have as little savings as they have, they're stuck with massive mortgages and paying off these car loans and debts that they've accumulated in this spend phase, and the savings that they do have drops a lot. You think the savings numbers look bad today, just imagine how rough they're going to look in this next period.
Right, and right now we have a period of full employment. When things get bad, of course, there's going to be layoffs and a lot of defaults.
Well, this is the problem. And you know what? There doesn't even need to be a lot of defaults because at the margin, so they say, at the margin you might see a 10% increase in the amount of people defaulting. But at the margin is where all that trouble comes. As we saw in the subprime debacle in the United States, it doesn't require everyone to default. It just requires certain people to default, which has this kind of a trickle effect throughout, defaults hitting levered financial products where people had banked them as safe assets for income and all that stuff. It's all interconnected because of the securitization of these markets. And people not having enough cash as a buffer to get them through periods of unemployment, to get them through periods where their business may be underperforming or doing poorly. Having lots of debt and little cash and liquidity and, whatever savings you do thrown into these casino-like markets is a recipe for financial hardship. And that's why, it doesn't, as I say, at this little savings, liquidity, and high levels of debt, it actually doesn't take a big decline to have people having trouble. They were already struggling, Jim, as you know, at full employment with, before housing prices have come down, before interest rates have even meaningfully increased, we still have mortgage rates under 5% for most people in this country. And in these conditions, you were still having very poor savings levels and a lot of financial strife. So it just takes a little bit of more trouble for that to, as I say, cascade into much more strain.
Danielle, you were a good person who promoted, why don't you look at your lifestyle and perhaps cut back on things you don't need, downscale a little bit and save some. Now in times like this, that's such great advice. But
I've seen this in my career and in my own life, Jim, so many times. The most humble, honest financial advice focuses first on getting debt paid off, getting people to have good spending habits, putting away savings, keeping it liquid, keeping it safe, not getting your head turned around by all these, speculative opportunities that everyone's trying to sell you in exchange for your cash. The true best thing to do is to manage your personal balance sheet. As I say, live within your means, build up your savings, and when you do have savings, keep it safe. And yes, there's opportunities to buy things when assets go on sale. Just like when you go to the mall and you see a whole bunch of clearance sale stuff, there's opportunity to be had. But when pricing is fully loaded at the most expensive that you've seen in several years, that is no time to be trading your cash liquidity for these assets. And that's what people have been doing in the past couple of years, and that's why I'm afraid they're going to pay the price.
Danielle, anything else you'd like to add to today's show?
Just keeping this in perspective, everyone talks about the sell-off and when's it going to end and, how bad is it going to be? What they forget is that on the other side of this lies tremendous opportunity to pick up assets, whether it's housing, whether it's equities, whether it's corporate bonds, debt, whatever it is coming on sale. And that is how you actually get ahead in life, is by, as I say, keeping your personal balance sheet under control, getting rid of your debt, getting your net savings up, and then waiting for things that are truly attractive as investments. We're coming into that period again, and now is the time to be prepared. And I just hope people take that to heart.
Danielle, thank you so much for talking with us.
Thank you.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. If you have any questions for Danielle or any of our other guests, you can send them to info@housestreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of House Street Media Incorporated.